Welcome to Multifamily Method, a podcast which explores the state of the multifamily real estate market and some of the backgrounds, methodologies, and words of wisdom from some of today's most successful multifamily real estate entrepreneurs nationwide.
Today we have Frank Forte in the studio with us from Lucern Capital Partners. Welcome, Frank. How you doing today?
Hey, doing good. Thanks for having me.
Good. Glad to have you, and thanks for taking the time. You and I don't know each other, so this will be a little bit, the audience will be sort of getting to know us while we're chatting through it with you. But I guess let's just get started. Why don't you give me a little bit of background about yourself and how you've, what your background in the real estate industry, and then sort of maybe some of the little background on Lucern as well.
Yeah, sure. So I'm Frank Forte. I'm a managing partner and founder, and I also serve as our chief investment officer here at Lucern Capital. And, we're primarily multifamily based, a lot of value add and opportunistic earlier. So we launched somewhere between 6 and 7 years ago. We launched with the mandate really of pursuing value added and opportunistic workforce housing investments, right? So this was 2016, early 2017, when workforce housing had just sort of become more in vogue. And I had left a company called Berkadia. I was an agency banker there and started to see the writing on the wall of what was going on. And these are the days you could still buy 7 and 8 caps in Charlotte, right? And Atlanta and places like that. So these are also the days before all you brokers decided to get together in a smoky room and sell value add deals for lower cap rates than core. But we'll get into that later. That's when you could still buy deals at pretty aggressive cap rates, and you had, this interesting confluence of stuff. There was this housing shortage that was going on. Financing was solid, even though it was, 4 or 5%. So we started, and, back then you could underwrite high teens to a 20 on these value add deals or above, and it was great. So we got in with that mandate, and I partnered with 2 gentlemen. I was sort of looking for a capital partner. Came across 2 guys that were looking to do something similar. They didn't know the basics of the business, but they had investors. They ran a short-term lending company at the time, fix and flip, spec home construction, that sort of stuff in the Northeast. They were doing good volume, and I sort of had a ton of know-how, had been on a lot of sides of the table, and we came together to form Lucern. So have done probably somewhere between 230, 250 million of volume during that time. I've been in the Carolinas since the beginning, dabbled a little bit in New Jersey and Philadelphia early on, primarily just Carolinas focused and Southeast focused now. So it's had a great run. We're based here in Jersey. Overall it's been Market Street does really well. My personal background was I sort of got out of school during the financial crisis. So the world was falling apart. Always actually wanted to go to Wall Street. My second love was always real estate. And it's actually pretty funny, outside of anything politically oriented, I loved the book, The Art of the Deal as a kid, by Trump. And it's just a classic, if you like real estate and it's just a classic sort of real estate book. And always loved that. I was always interested in finance from a young age, started trading options at, 15 and 16, and was always a big math person. So always thought I was going to go to Wall Street. I was going to be maybe an options trader, commodities trader, something sort of high risk, high reward, fast paced. And the bottom fell out, right? We're in class one day and they come in and Lehman Brothers collapsed, this, and this. And you quickly realize, hey, I'm not going into finance, right? So I got a job as a consultant out of school working for the Treasury Department of the U.S. And we were taking these community banks that were failing because they had these atrocious loan portfolios, and we were merging them together, closing them down, helping to recuperate them. And I was on this problem bank team. So it was the worst of the worst. Traveled, throughout the U.S. looking at these small banks and helping to fix them. So super cool opportunity. Pay was not great, as you can imagine, being a government adjacent employee. And then sort of went on to a variety of roles, one of which was an analyst at a small private equity and debt shop. Ironically, not far down the road from where our office is now. And we were just in the senior housing space. So it was fractured back then. You could still do 17, 18% mezz loans. And so we were swinging that stuff. I was an analyst there. And then I had gone on to work for a drop down of Fortress and CW Capital on the turnaround of the Stuytown deal in Manhattan. If you're familiar, it's the biggest residential, foreclosure, biggest CMBS default in history. And I worked there, spent some time at Berkadia as a debt banker. And then that was my last sort of gig before going and starting Lucern late 2016. So sort of always felt like I wanted to do my own thing, never knew what it was going to be or who it was going to be with or what it was going to entail. But the experience that I had sort of shaped me and put me in this position where I sort of had a very clear idea of something that I could do and scale and build into something really cool. So 6-7 years later, couldn't be more happy of where I am. Things have gone really well. We're obviously super blessed and fortunate. Best is yet to come, hopefully. So it's a little intro of us and our background.
So you at Berkadia, you were financing the types of deals basically that you ended up buying at Lucern. Is that accurate?
Yeah, that's accurate. I was in the New York City office. We were doing about $2 billion a year out of the office at that time. It's a very interesting place for Berkadia's headquarters to be and to do agency loans, right? Because our territory, we were always allowed to call down to the Southeast, and invariably we did a ton of business down there. But could you imagine trying to sling agency loans in New York City? Just doesn't work.
Right.
So I got acquainted with a lot of the markets throughout the Southeast and even the Midwest because we were always doing deals. So you get this sort of supercharged education on all these markets you had no idea about. And, I'll admit back then I was ignorant, right? You sort of think, hey, if you don't live in New York or LA or Chicago or Miami, like, what the hell do you do for a living?
Right.
How do you make money, right? But so untrue. But that's what happens when you're, mid-20s and work and live around New York City your whole life. You're in a bubble. So it was a very eye-opening experience.
Yeah, and you can make less in other places and live better because it doesn't cost you 5 times as much to live.
Well, that's what you realize later on, right? That those people are probably happier. You make $150,000 a year in the middle of nowhere somewhere. You're the king of the hill and take your family on vacation, go on a golf trip with your buddies, do whatever, drive a nice car, and you have a great life. And as opposed to, living in New Jersey, you make $250,000 a year, you're middle class. So trade-offs.
Yeah. So how'd you meet your partners at Lucern?
So it's actually interesting. I don't really remember exactly how where we first met, but I was buying some deals in Philly at the time with another gentleman, and we had a deal under contract, and we were hard. It was a small deal, $1 million deal, $1.5 million deal, something like that, 28 units, tough part of Philly. And we had it under contract, went hard. And I don't remember who, but there was someone, it was family, friends money, and someone had pulled out. And, we had this money hard, which is a lot for us back then. And we're sort of calling around and saying, who can help fund this deal, get it into the closing table. Talked with my partners who I had met at some conference or something and said, hey, here's what I can give you. Here's what I need. Let's do the deal. And we did that deal, and that deal was actually outside of the banner of Lucern. And then that is what sort of, spurned this whole partnership between us. We said, hey, we can do this times, 100. Let's get into bed and let's do it. So talked for a while and sort of took a little bit to get us all on the same page. And then we sort of, that's what kicked it off.
Cool. So other than the fact that you could buy a 7 cap at the time, why the Carolinas?
Correction, Jad, it was an 8 cap, but that's okay.
It was a broker 8, but it was probably really a 7.
Yeah. Exactly. Listen, there's only 2 things that drive value. I have a unique background. I was always a heavy finance guy, heavy corporate finance guy, loved investment banking, loved corporate valuation. And real estate valuation is really the other side of that same coin, right? All valuation comes down to the core tenants, right? And you have earnings, right, or a cash flow stream, and you have some sort of multiple, right? And that's really what it comes down to. And there's only 2 ways it goes up in value. One, you get cap rate compression, right, which we've seen, just heavy duty cap rate compression over the last 10 years. And the other way is an increasing, cash flow stream or NOI. And the only way you move rents is by folks' income going up. There's only so much people can absorb, right? There's a reason it's that 30% plus or minus metric everyone uses before you get squeezed as a household. So how do you get rent to go up? Well, people's income needs to go up, and corporate relocations need to happen. Better jobs need to come. And as you see that happening in the Carolinas and the Southeast in general, because they're more business friendly, there's less friction, political climate's, more stable, the tax base is better. That's where you can buy something where the rents are $1,000 and 5 years down the road you're looking at 1,400 chunk rent, because folks' income can support it. So that's sort of the antithesis a little bit to the argument that like affordability in the Southeast is going to crap. Yes, has it become squeezed and has it become higher than it was? Sure. And we look at this closely. It's one of my big metrics I look at, but people's incomes have accelerated so dramatically. And yes, has it wavered up a little bit over time? Sure. But, New Jersey, average apartment in Jersey is sometimes 35 to 38% of your income. Charlotte's sitting at 23, 24%, still a far cry from being, legitimately rent burdened. So those corporate reloads and that momentum is a lot of what drew us down there, and a lot of what keeps us there, candidly, and will for some time. So,
got it. So where in the Carolinas have you bought? Just Charlotte or some of the other markets as well?
So right now we're heavy duty in and around Charlotte, MSA. A lot of the product we own is in the city, and has been in the city limits. And now we own some product in Wilmington as well.
Okay.
So those have sort of been our two main bases. Bid on stuff in other markets before, would have been happy to win something in Raleigh years ago, never did. And, sort of feel like I got boxed out by rising values, similar to those same guys who probably, were in Raleigh and wanted to buy in Charlotte. But, would have loved.
Well, if you want to talk about wage growth, like what wage growth in Raleigh and in the Triangle area in general, I mean,
nuts.
Yeah.
Nuts. I mean, it's crazy what's gone on. And it's funny because like 2014, 2015, people thought that about Atlanta, right? Atlanta's done. It's had its run. There's stuff in Cobb County or the Cobb County or whatever it's called. And, it was going for 40 grand a door back then. It went to 80 and people were like, there's no way 100% growth. Like, it's not going to happen. And then you watch these values just,
right.
Before you hopped on, me and Q were talking about if I'm sitting across from you guys in 3 or 4 years in Class C, multi in Charlotte's going for 400 a door, we got problems, right?
Right.
So,
right.
I don't think it ever gets, I don't think we see the run up that just happened. It was super unique, confluence of events, perfect storm in a good way. Don't know if we see that sort of growth, but listen, it's okay. I think we're going to go back to historical growth patterns, which still work and are supported structurally. So,
yeah, I mean, the reality of the situation is we were all doing well in 16, 17, 18, and 19 before all this stuff took place and changed the trajectory from this to this, and then it's gonna plateau and then get back to a normal trajectory. I think I agree with you.
Right.
On that. Yeah.
Right. I mean, listen, look at Jersey up here, right? You might not be so familiar with multi up here, but brand new construction multi in Jersey goes between $400,000 and $500,000 a door when it's done, right? Nuts. Yeah. And why is that, right? It's just a simple math equation. The rents are ridiculous. It's very difficult to build. We always say up here in Jersey, a zoning change takes divine intervention, right? It's not as straightforward as in the Southeast. So, but again, like when you have rents that are $3,000-$4,000 a month, like that's just where the stuff comes. So it's very interesting to kind of see, and I think it'll be interesting to see what happens with cap rates too.
Yeah. What is so tell me about the first deal you bought in the Carolinas. Give me sort of like the deal story, like the high level deal profile and just summary on it.
Yeah, absolutely. So it's a crazy one, and I don't know if you knew what happened with this one. Maybe that's why you asked or you didn't. But
no, but that's it. Typically the first, everybody's first deal. There's usually a good story behind it. That's why I usually ask.
Oh yeah, this is a good story. All right, so you're in for a treat on this one. So we bought a deal off of Farm Pond Lane off Albemarle in East Charlotte, which still is, depending on the pocket, really tough area. And we bought this deal, and it was sourced through a guy we knew who didn't know much about the Carolinas at the time, and he was digging around finding deals. Sort of wasn't equipped to operate it, but called us and said, "Hey, there's this deal. I don't really know what to do with it. Let's partner up." And we did, and so deal was like 35-40% occupied when we bought it. 45 days after we bought it, which was my wife's birthday. I wake up with my wife, we're going on vacation, and I wake up to a video of like someone running, and you could see the cell phone like going like this, and they're going, get the heck out of the building. And then it pans over and all you see is just flames. And I'm like, Jesus Christ, right? Like you gotta be kidding me. So it turns out some guy, he was a legal immigrant, and he found out his girlfriend was sleeping with someone else in the building. Gets hammered, goes there at 3 a.m, tries to light her and her mother on fire, and ends up burning down basically half this building.
Oh my gosh.
So now you have this deal. It's in cinders, 6-7 alarm fire, biggest fire in years in Charlotte. You got all this crazy stuff. The people at the Red Cross shelter were sending pizzas there, like, hundreds of pizzas, like all this nuts stuff going on. This is an early deal for us. So we're personally guaranteed on this, right? It's a high leverage bridge loan. The insurance company won't pay out at first because they're saying, hey, we don't know who lit the fire. Was it arson? Did you guys, burn it down? Blah, blah, blah. The lender won't advance funds because the insurance company won't pay out. And you got this building in cinders, and, the Charlotte Fire Department going over there basically with hedge clippers, just cutting all the electric off. Right? So this thing looks like, just like a bombed out, piece of what. And it's nuts. And, people printing news articles, the fire alarm didn't go off. We're having our lawyers send notes. The Charlotte Fire Department's writing letters that, hey, the fire equipment worked properly. It's a freaking ultra disaster, right? And ultimately, the guy ends up coming back who lit the fire like 7 or 8 days later, and he's coming back and bragging to other people that he's the one who burned it down. So they scoop this guy up. They charge him. He ends up getting deported. Finally, the insurance company begins to pay out a little bit. That was a disaster in and of itself. It was a 3-year lawsuit after to recoup extra dollars because they tried to not pay us out on part of it. And it's just, the whole thing was a shit show, right? So, and hopefully I can curse on here, so I apologize.
Yeah, no worries.
I figure it's a podcast. It's a little edgy,
Yeah.
Just have a good time. So it ends up being a disaster. Long and the short of it, the investors ended up, I don't have the number off the top. It was like a 59 or a 62 net IRR. We were going to smash it to begin with on this deal because of how we bought it. But we ended up absolutely murdering it, leased it up, new siding, new windows, all this beautiful. The property was beautiful, and we sold it to another operator during lease up, and ultimately ended up exiting and doing really, really well. And but just like absolutely like bonkers.
How big of a deal was it? How many units was it?
It was an 80-unit deal.
Okay.
And there was 20 units in the front and 60 in the back, and they were separated by like this big kind of open space. There was a pool and this other stuff, and the back was like almost like a big rectangle with like breezeways that go into the middle. So basically half of like that horseshoe in the back just burned down. And I mean, it wasn't like, hey, kitchen fire. It was like legitimately like this thing got, someone fired a cruise missile or something at this thing, and just, it was like a drone floating somewhere, popped this thing. So great experience. Obviously taught us a lot. You learn to not be scared of insurance claims after that, and they can be your friend if it's, depending on how it shakes out. But all in all, great learning experience, and great moving to the Charlotte. And the best part about it is I got one of our best GCs who we have an amazing relationship with. We got him because I was just calling around, right? And I didn't know anyone in the market. So I'm just pounding people's phones. And it turns out he was driving down to the beach with his family. And I guess, it's a funny story, but I guess like him and his wife were having some argument. So he just picked up the phone because he was just like wanted to end the argument. and that's how we got. And now he's, I consider him not only a good friend of mine, but he's just our go-to guy. He's trustworthy. He's just amazing asset to us. So it's funny how some of these things work out, but there's definitely a point in time you're like, oh my God, this could be really bad. So that's the story.
That's amazing. So so you started with 80 units, and now how many units do you have in the Carolinas? How many units are you currently operating in the Carolinas?
We just sold a small deal with Capstone. As a deal that we bought some years ago. Tough deal. We're probably somewhere around 900 units plus or minus.
Okay.
I want to talk about a strategy, if you don't mind. I think it's a good thing to talk about a strategy we had that's paying off well. And it's kind of a strategy we've always had. So we've always attempted to go into a market and aggregate a lot of smaller properties and then package them up, clean it up, do the work, and sell it to a larger investor who wants, exposure to X submarket, whatever it is. So early on, we saw West Charlotte was beginning to have some movement. And it was tough back then, right? It represents, if you look at Charlotte, it represents half the damn metro. And for years, it wasn't even on a rent comp report. They didn't even consider it a submarket. It's like, guys, it's the whole half of the city over here.
Right.
And which is fine. It was totally cool. And we were picking off these deals for very low prices. And a lot of which we bought through Capstone. And, some of those guys probably even thought we were, they're not on here to defend themselves, but they probably thought we were crazy at the time. But we're like, no, you're going to see it. Like, it's going to move. It's so close to the city. So the east side at that point it stretches much further out than the west side. So like the west side is much more proximate. You got the airport, you got all these manufacturing jobs, you got UPS, you got just an innumerable amount of really good workforce employment. And it's just so close to the city. So we bought this little 44 unit deal, which is the first, I believe it'll be the first of many proof of concepts of our sort of thesis. We bought this little 44 unit deal. It was so bad when we bought it that we literally didn't put LPs into it. We all looked around. We're like, nah, like we can't put our investors in this. Like it's that bad. Tough deal. Some people were paying $500-600. The grass, we bought it. The grass was like waist high. It hadn't been cut in like forever. Like the thing was just like, it was awful, right? 2 days after we bought it, someone stole all the laundry equipment. It was just like one of those deals, right? You're like, geez, like this is going to be rough. And so we put an agency loan on it, right? God bless the agencies. The worse it is, the better financing you get. So we put an agency loan on it, started to turn it around, move the rents, and we actually just traded it recently. Capstone actually represented us, and we ended up, it was a 4x on our equity, wow, which was just outrageous. Notional dollars, really strong. Not, if this deal was 3x the size, I'd probably be sitting on an island. I wouldn't be talking to you.
Right.
But first of many proof of concepts, and we own most of our portfolio at this point is on that side of town, and the rent growth has just been absolutely stratospheric. But we're putting in a lot of money. A lot of I would say over the portfolio over there at this point, we've probably put in somewhere between $5 and $6 million across 700-800 units over there. So actually a little bit less, maybe about 600 units. So we put in a lot of CapEx, and we've tried to make these places nicer, but there's a lot to contend with. It's a tough tenant base. There's crime, obviously, which is, has been abating as time has gone on. This is a city. It's very difficult to deal with the city these days in Charlotte. It's gotten very, very, the affordability conversation has reached a fever pitch. And then with that, it's spun into just a very aggressive code enforcement department. So we've had to deal with a lot of that, which is honestly very trying. It's tough when you're trying to make this stuff better and they're coming after you, but a lot of challenges. But long and short of it, I think that strategy is going to pay off really well. So that's what we like to do. I don't want to buy the sexy, high rise with a golf simulator. It's not there's no yield there for us, right, or investors.
Right. No, and we've seen a bunch of groups do that in pockets of Tampa and pockets of Sarasota, where they've gone in and bought all the boutique deals down there and created some scale and really become the provider of housing in those submarkets.
That's right. Yeah, it's a great strategy. Tampa. So tell me a little bit about Tampa, because I know you're heavily down there. I see your face come across my email all the time, and tell me a little bit about. Tampa is top 3, rent growth.
Yeah.
At any point you looked at it, I feel like.
Yeah. So Tampa, I moved to Tampa 18 years ago, and it was strictly for the weather. There was no other reason. There was not a whole heck
not for the cigars.
Yeah, no, not the cigars. Although I did, I do smoke a cigar from time to time, but that's not why I came down here. I came for sunshine. I grew up in Cleveland, Ohio, so I came down here. It was February, and it was just, I have a cousin that lives down here, and I just decided to make the move, and then got into real estate after I got down here. But there was no population growth to speak of, no job growth to speak of. The industry was largely tourism at the time, and not really a diverse employer base down here at the time. Real estate values were going crazy, but it was a function of everything else that was happening in 2005, 6, and 7. And I started flipping houses and was selling into the subprime borrower market at that time, in kind of lower income neighborhoods that were, that could now buy. And
public enemy number one. I'm looking at him.
Yeah, but you would go. I mean, well, I wasn't the one making those loans, the picket payment loans where you could do
right.
You could the neg-am loans, which I never understood. I would go to these seminars and just never understood them. But hey, I didn't tell people what loans to to sign up for. So spin it forward, I guess it's been, 12, 13 years now. And it's just, it's been a total transformation. I think, just the larger trend of job growth and population growth to the Southeast, quality of life of Florida, like you said, business friendly, low regulation, no tax, no income tax state. And, we see, I don't know, 500,000 new, net migration into the state every year. And it's probably even more than that, frankly. I feel it in my car, driving my kids to school. It takes a lot longer than it did a few years ago. But we're also beneficiaries of that. Where my office is, I'm half a mile from the Water Street district, which is the $3 billion mixed use district that Bill Gates's private equity shop and Jeff Vinnick, who's the owner of the Lightning, are JVing on, and they've delivered phase 1 and they're starting phase 2, and it's $1 million condos and boutique hotels and an office building, a high-rise office building, and high-end restaurants and the whole deal. And it's a total transformation of an area that was largely surface parking lots. And where we are, we're on the wrong side of the tracks. It's still a great neighborhood, but our office lease, I think, is like $35 a square foot, and half a mile down the street, it's $55 a square foot. So, but the other thing is there's just been a lot more diversity of jobs coming into the market. So you're starting to see like a real tech movement into tech down here. Like little tech incubators are popping up and fintech coming in down here. Obviously, healthcare is always big down here. Financial services jobs are expanding down here, and so you're starting to see more diversity and more high paying jobs, which is supporting what we've seen to be 25-30% rent growth since really the beginning, since sort of 2021. Like the last 12 to 18 months. Now,
well, that's it. That's it. See, the corporate reloads and the better jobs. It's the only way it comes up.
That's right. That's right. And the very real dynamic that we have far more people than housing units. And that's nationwide. That's right. Most, a lot of people probably don't know the statistic that we think we're probably anywhere between a $2 to $3 million housing unit shortage in this country. Depending on, and obviously, from market to market, it's different. I think it's probably on a pro rata basis, even worse for Florida, just because of what's happening with the migration trends. And so, fortunately, you can build down here and you can build more housing units, and it's not, the restrictions, by and large, are not that onerous to be able to deliver units. Obviously, different municipalities have different challenges, but
that's it, right? So like the statistic we always find is even higher, right? It's somewhere between 5 and 7 million, and no matter where you look, right? Some of those people hack it up, it's single family, it's multis in there and whatever. So even middle of that, let's call it 3 to 5 housing units short. Each time there's a recession, the builders stop building, right? And what happens on average, there's 700,000 to 1 million new housing starts in America per year. So that wedge just gets wider and wider. And I'll give you a statistic that maybe you already know, you probably already do, but last year was the best building year on record since the early 80s. And so last year was like 942,000 plus or minus
Right.
we built, and it was like 1 million housing starts. So best year in 40 years, and we just barely scratched the surface. Now, will it catch up a little bit because you're going to have housing deformation occur now into the next 18 months as a result of everything that's brewing, right? And by the way, that's the biggest risk to our business long term. Multi is
right.
The structural imbalance that we all benefit from. That is the biggest risk to it long term. And honestly, on Class C and the workforce stuff, it's migration, right? And immigration, quite frankly, and whether it's legal or illegal. Reductions of immigration, doesn't matter politically where you sit, reductions of immigration will hurt our business long term, because at the end of the day, that demographic of the need of housing is growing, and there's no more being built. So it's
right.
even more acute imbalance, right? But nevertheless, like, it's just bizarre to think about that last year was that best year and they still didn't scratch the surface. So what's going to happen? We'll go through 18, 24 months of funkiness, deformation, it'll be lower, it'll catch up. And then what's going to happen? We'll hit a boom time again, and the wedge is going to be wider, and it's just going to continue to widen. I mean, it takes sustained, concerted effort, of which I don't think as a country we are prepared or capable of coordinating to chip away at that. So who knows how long this goes, but unless you see some big pivot, I don't see how it gets corrected anytime in the next decade.
Well, it's interesting because we still, we do sell a lot of development land down here, and we're still seeing like there, I mean, look, there's certainly been an impact on demand. I don't want to say there's no shortage of demand for sites, because there are, and typically like it's the more secondary and tertiary markets where those have kind of either been put on pause or discounted heavily to make the numbers work. But I mean, we've still got developers very interested in acquiring sites in places like Melbourne and Jacksonville and Apopka, which is suburban Orlando, and forget about Tampa. If you can find a site in Hillsborough County, I mean, you're golden. But now I think the challenge is more, what are we underwriting to? What's the interest rate going to be when we go to exit? When are these costs going to come down? And trying to find the sweet spot on all of those things. A few years ago, you could build a deal for 200 and you were trading it for 350, and even the deals that are delivering today, because they were, think about it, their GMP was signed probably 24 months ago. So they're building for 210, 215 all in basis. But if you're contracting a deal today and those 215 deals, you can still probably sell for 260, 270. So you're, feels pretty good. 50 a door. I had a developer tell me, like, we don't need to make 100 a door profit on a deal. We like doing it, but 50 makes sense for us. But now you're building to 275, 280, 290, because the construction costs have, there's always a lag on when they start to come back in line. And then you just need to hope that, when you go to sell or refinance in 24 months, that the 10-year treasury is at 250 and not 350.
Right. Yeah. I mean, I think the developers, and that's a great point. And I think the developers that are making money in this environment or going to make money in this environment, they're the guys who have tried and true product, footprint, right? And it's that solid Class B sort of build, not super high end. It's maybe in a part of town, you grab the land cheap and you build this thing and you just throw it up. And you're in a pocket where rents are accelerating. Those guys are making the money. The guys that are chasing, you're attacking the pin and you're going full on at it. It's going to be difficult. And what's funny, what you said is you're talking about historical development costs. I remember when I first got in this business, developers wouldn't even look at a deal unless there was a 400 BIP, maybe 350. They would go spread yield on cost, right? That was like the rule of thumb. Then it became like 250, then 200. And then you had guys in the last 6-12 months, like, we'll do it for 150. Like, that 150 goes in the blink of an eye if you're caught on the wrong side. Now, fortunately, multi is resilient. It is the Southeast. Like, you're going to catch a bid from a family office or someone way lower than a private market sale, because those people will be buying in cash or 1031. So you'll be okay. How much money will you make? TBD. I don't know, but you'll be okay. Whereas it's not like 07, 08 where these people are going to get caught pants totally on,
Well, right. And the thought process, or not the thought process, but the way it may end up playing out is, the guys that are delivering now, even though pricing has come down 20%, your basis is low enough that it doesn't matter. And by the time the guys that are coming in at much higher basis on their project deliver, the hope is that, between rent growth and, interest rates, more normalizing, I guess, over the next 18 months, then they'll still be okay too. There will be a period of time where you're not going to be okay. And it's just going to be the guy, maybe the guys that aren't as efficient, or whose cost of capital isn't as cheap, or who maybe built a more tertiary, maybe over improved a deal in a more tertiary market or something along those lines. I mean, there'll be some of that, but I think all the other factors will sort of moderate and make it less painful than it was, a dozen years ago.
I agree. I got to tell you something. There's a really interesting dynamic that I think has taken place over the last decade since, GFC, right? And what that dynamic is the following: is I don't know how much distress, and I'm specifically talking about multi at this exact moment in time, right? Forget about retail, no office, no hospitality, whatever, multi-oriented. Right. Maybe you could even roll the dice on industrial in this conversation, but for argument's sake, keep it out. Multi has gotten to the point where it's almost, and I don't even want to say this out loud, put it in the universe, but it's almost at the place where no one will let it go down, right? So great financial crisis, you saw housing in general in the aggregate take a crap, right? And rents took a little bit of a hit. People really didn't lose money. The agencies, fun fact there is Freddie and Fannie lost almost nothing, right? Historical defaults, they were, double what their normal rate of default is, which is probably 30 basis points, 40 basis points. So they lost almost nothing. It's underwritten well, even though it's non-recourse, low leverage, standard agency leverage across their entire portfolio is upper 60s, right? So they're well insulated, yada, yada, whatever. But COVID should have been the undoing of multi, and it wasn't. And you saw the government step in, whether appropriate or not, and, mandate, tenants were going to stay in these units longer, and mandate that, hey, if you want this forbearance, you can get it. And you had all that happen. So these people who should have been washed out in the flood never got washed out, right? And now you're seeing it happen again, where I get blasted every day. And like we're doing small balance pref equity right now, right? We're not advertising it. We're not screaming it from the rooftops. But if an operator comes to us who can't raise that capital and they need a $1 to $5 million check, we're looking at good deals that make sense in markets we'd want to be in, right? Why wouldn't you? You could get risk-adjusted yield not dissimilar to owning something and be in a protected position and have access to deal flow that maybe you wouldn't have seen, okay? So now you're seeing this thing where I get pounded every day with mailers from groups that are offering rescue capital and different capital to bail out guys on bad bridge loans. So it's going to happen again, where you're going to see people are going to be forced to sell. You're going to see inventory hit the market, but these aren't going to distress levels. There are going to be people who will catch a bid at a 5.5 or a 6 cap and be like, yeah, I'll still take that deal long-term, multi Tampa, multi Charlotte, Raleigh, whatever. No one's going to let these things go to crap. So it's going to happen again. And each time this happens, it just continues to solidify this growth, this meteoric growth in prices. And it almost makes you wonder, by and large, unless there's some catastrophic event, when does the acceleration of multifamily prices stop? Like we're joking around about
who's holding the paper today on all these deals that traded in the last 24 months. They're debt funds. What are debt funds? They're basically an extension of private equity, right? So they're not going to take a loss.
That's right.
They're going to figure out a way to source. They're going to figure out a way to get the deal serviced. They're going to become asset managers if they have to be, and they probably won't.
That's right.
They're going to be in good shape from all the rent growth that they've seen. But let's just say, devil's advocate, they're at par under their loan position. They'll become asset managers. They'll hire good management companies. They'll bring in, some of the bigger shops and they'll navigate it until they can, sell it, until the interest rate environment or the capital markets environment allows them to sell it at a profit, or at least get out clean. But, these debt funds are effectively private equity, and they're going to figure out a way to sort of navigate the waters until the market shifts back in the favor. It's not like it's the Fannie Mae and they got 10,000 units and they're giving them to the servicers and just trying to get them off their books, or they're big national banks that are just trying to dump their balance sheet because the federal government's telling them they have to. Like that's not the dynamic that we're entering into now.
Right. No, I couldn't agree more. Now, I think, if you're in the office game, or you were unfortunate enough to be in some of these other asset classes, you're gonna feel the pinch. And part of that is there's no need for that. It's the opposite way around, right? People are saying, hey, how do I reposition these old properties? Do they become last mile logistics? Do they become, apartments? Do they become this or that? Those are tough, man. When you see suburban office trading for $50 a foot, you're like, holy crap, like this is a lot of square footage for this price. Just from a basis standpoint, the wheels begin to crank. What can you do with it? We're converting a hotel right now in Charlotte. I don't know if you knew that. Bought a hotel up in University. It was a town place suite.
Okay.
And the guy sort of crapping his pants during COVID and doesn't make any sense, right? In a really nice area in the research park, 15,000 jobs within a couple mile radius. Household incomes are up. And this guy filled this with people who effectively were unbankable. So, gross abuse, right, of a landlord is like charging these people $2,000, $2,500 a month. These are people who normally would be in $1,000 a month apartment if they could qualify. So they're funky people, and we had to deal with that. But you look at this and you say, wow, just from a bricks and sticks standpoint, like this makes so much sense. And we got in at a great basis, got good financing, and we're a few months out from CO, and then we're going to begin leasing up. But you see all these adaptive reuse plays now that are coming down the pike. And I think you're going to start to see the office conversions in the big cities, the office towers that are sucking it, that were supplanted by brand new office product, right? With better amenities and air filtration, right? And all this crazy stuff. So it's going to be interesting to see what happens with that stuff. But I think by and large, we've all been very lucky to be in multi, and it feels like it would take a lot to knock it off its perch.
The Multifamily Method is powered by Capstone Companies, the largest privately owned multifamily investment sales brokerage nationwide. Capstone Companies provides dedicated coverage to both primary and secondary markets throughout the Southeast, Mid-Atlantic, and Midwest regions of the United States. Whether buying, selling, or refinancing, Capstone Companies is here to help. Simply put, Capstone is expertise, experience, extra mile. If you're interested in having Capstone provide a complimentary opinion of value on your multifamily asset, please visit us at capstone-companies.com.
Yeah, I mean, it's especially in the Southeast. I mean, I would not want to be a guy that bought a 4-cap in Detroit 12 months ago. And
no.
I'm sure those guys are out there, right? Like that. I'm sure that happened. And those are the types of situations where I think you could see some kind of a distress, and where the basis may never come back. But if you're in the Southeast and you're in an area where the population trends and the job trends are working in your favor, you're probably going to end up being okay. So,
yeah, I agree.
Yeah, so now that we've figured out the market and what's going to happen over the next 24 months, I'm interested to see sort of how you guys at Lucern are sort of shifting your strategy or what your investment approach is going to be going forward, now that we've all had 6 to 9 months to sort of digest what's taking place around us.
Yeah, no, it's a good question. So we were doing one-off deals for a long time, right? I avoid the word syndication because I'm not here shaking people down for their lunch money like some other people. But that's just a funny little joke. I'm glad I got a smile out of you. But we launched a fund during COVID, small fund, $25 million, sort of a bite-sized test the waters fund, and we fully deployed it, $93 million of product. So we're going to raise another fund in the next 6 months, probably be 35 to 50 million. And, we kind of put it on hold given the climate and it's ready to go. So it'll be spooled up when the time is right. But we're going to start to focus on probably we're still going to be value add. We're always value add, opportunistic oriented. We're going to start to focus on, it's going to be the same Southeast type strategy. The fund is going to have a little bit more mandate for us to go out and potentially buy some industrial and do some other stuff. I'm bidding on an industrial deal in Charlotte right now, not for the funds, but just separately. Don't know what'll happen with it, but now the focus has sort of been, hey, let's focus on the Southeast and its growth pattern in totality. And it'll probably be 85-90% multi, but I think it's going to shift a little bit. So we used to buy a lot of 70s vintage stuff, right? We weren't scared of it. A lot of non-revenue generating CapEx, right? A lot of roofs, parking lots, flat work, you name it, right? HVAC, plumbing, the whole nine.
Yeah.
Plumbing, right?
Yeah.
If you got that poly B leaking through, but you look at it the wrong way, it springs a leak. You got to watch out. By the way, that deal that burned down in Charlotte had a ton of poly B in it, and we remediated a lot of it. But I never forget one day I was in there talking to our GC about how bad the pipes were. Leaks from literally right in front of us. We're like, this is insane. Big tractor trailer goes by, the ground vibrates, and the pipe freaking bursts. So, but yeah, so we're going to start to shift, I think, towards better quality stuff. It's still going to be probably 2000s or older. I would buy some early 2000s stuff, but the strategy for this new fund is going to be try to identify stuff where there's a better ROI based on investments. And we've kind of been there, done that on the 70 stuff. I think the values from a lot of that stuff have gotten heady. Listen, you knock me over the head with a great 70s deal tomorrow, I'm buying it. No problem. No questions asked. Not scared about it. Don't care if it's the ugliest, building on the front of the investment book, right? Sometimes those deals pay off the best, but I think we're going to start to shift towards nicer stuff. We're going to expand the markets. Charlotte will always be a home base for us. I love the market dearly. It's become like a second home to me, and go, once a month for the last 6-7 years. So it's like a home to me, right? We look at Charleston. We've looked in the upstate quite a bit, Greenville, Spartanburg, those sorts of markets. Interested in Savannah. You and I can chat offline about Florida. Like I said, maybe now you don't feel like the schmuck buying in at these. I'm half decent, but
I'll find you a 5 1/4 cap. Yeah.
Yeah, that you're selling to everyone else at a 5.5. No, I'm teasing, but yeah, that sounds good to me. But yeah, so we're gonna look in the Southeast, look at some new markets, and I think overall try to grow our footprint. Been interested in Tennessee. We've bid on some deals in Knoxville. Specifically the west side of Knoxville is really interesting thing going there. So yeah, I think the strategy is going to remain very much the same as it was, but I think what we're going to look to capitalize on is deals where, come hell or high water, folks can pay the rent. And I think that's how my mind has shifted. I have to tell you, over the period of COVID, when there was all the rent abatement and all that stuff, and we had some agency loans, things like that. I mean, that CARES Act really did anybody who operates in our space. It did us dirty, right? It became so difficult to get folks out, and you had our dumpsters were full of, new TV boxes and all sorts of crap that people were buying. Well, they weren't paying the rent, and that stuck with me. One of the reasons outside of all the corporate relo stuff we love the South is because New Jersey used to take 8-9 months to get someone out of an apartment if they didn't pay. That's how bad it is.
Right.
Down south, it was 45 days. So I think we're going to try to level up into some nicer quality stuff just as our business plan evolves. And, the goal is always do more with less. So from a resource constraint on our team, we operate pretty lean. We have some asset managers down in North Carolina. We have 2 analysts here. We'll probably add a third at some point. We have an investor relations woman, and then myself and my 2 partners. So we operate indirectly, we probably, employ 40 to 50 people, I would say, right? Directly is sub 10. And we do that on purpose, and we give everyone a lot of autonomy and a little sort of fiefdom to manage. So I want to
what's the division of labor between you and your 2 partners?
Yeah, so I'm our chief investment officer. I handle all of our acquisitions, our dispositions, and I oversee our asset management. My partner, Dave, handles all of our investor relations and our capital raising from our retail capital base. And then there's my partner, Mark, who's our third partner, and he sort of sits in the middle, does a little bit of everything, but does a lot of corporate operations, a lot of sort of risk management, and things along those lines. So we all kind of stay in our own lane, and it's very collaborative, but we each sort of have our own pocket. And then on the asset management side, I have an asset manager who does a lot of our CapEx and sort of expense side of the equation. And then we have an asset manager who does all of the revenue side. So the leasing, the marketing, the rent, sort of the rent setting and comping to the market, the collections. And again, they're super collaborative too and work close together, but we have a really strong team. And I have seen a lot of companies grow for the sake of growing, right? Where you see these things and they have 70 employees and now they're just doing deals to rip fees to keep the lights on. Like, I never want to get to that place. You don't have to, but the foundation's got to be right. So that's a lot of what we're working on this year. We actually hired a corporate coach recently who's been awesome to help us sort of refocus our platform and really answer the question of who we want to be when we grow up, right? And we are at a very critical juncture where we have this fund deployed. We're going to launch this second fund. Some of these other deals are going to be spooling out. We have done very well over the last few years. Things have been really good to us. We're growing, we're expanding. We have notoriety. We have an unbelievable track record, right? Net 33 IRR since inception. Absolutely murdered it. Some of that's the market going up. Can't argue with that. But a lot of it is we bought really good deals and we worked through them. So some of that where we want to go in 2023 and how it's going to change, some of that's still a TBD, but I think we all want to focus on better quality stuff still in the Southeast and grow those relationship sets we have and expand them and get to a place where we're managing a good, for me, there's no target I want to manage, right? It's not, hey, 500 million or a billion or whatever. I don't really care as long as we're making good money, our employees are happy, we have a good, strong team, and we never get to the point where I love real estate, right? I want to be in this business to do deals. I don't want to be in this business to wake up and say, shit, I got to do deals to keep the lights on. I don't ever want to get to that point. And unfortunately, a lot of people get to that point and real estate just becomes that vessel for the growth. It's not about the deals anymore. It's just about, doesn't matter if you own a plumbing company. It's
so
a
I just
plumbing
played
company,
golf.
right? So
I just played golf with a client the other day, and he said if you get too big, you get to a certain point, you're not a real estate guy anymore. You're running a company, right? And like, you're not doing deals. Right. You're just managing people, and it's sort of a fine line on how to get there, because obviously you got to buy more deals to make more money, but sounds like you just like doing deals, and I'm a broker, so obviously I like doing deals, and and my team's I deal with it too. I mean, my team's growing now, and so I'm having to balance working on deals and then making sure the team is cohesive and everybody's wearing the right hat and all that stuff, and that's managing people. And so it's a challenge for everybody when you get that's why they call them growing pains, right?
Right. Yeah. No, you got it right. And I think the devil is always in the details, and it lies in the quality of the deals you do. If you do 5 deals a year, it could be 100 million of deals, could be, 2021 when we launched that fund, we had our best year ever. We bought 100 million, just under 101 million of prize, best year ever. But we bought quality deals that underwrote well, and they're going to pay off for our investors. But how easy would it have been for me to go out and buy 10 and 12 IRR deals with that money and deliver our investors crap returns, right? Like, if you were an unscrupulous person who didn't care about their fiduciary responsibility and didn't care about how you were viewed, you could easily go do that and then blame it on the market. But that's kind of not who we are. So I'm always trying to optimize that with balancing getting volume and doing deals with having the right return profile. And I think that's where it's sort of, you could do 5 good deals a year, and if those pay off really well, it could be the equivalent of doing 15 mediocre ones. What is less resource intensive? 15 deals or 5, So there's always that balance. These are just hypothetical BS numbers, but there's always that balance.
So what are you working on today? Because obviously, there's not much deal flow going on. At least not in, unless you're seeing a bunch of deal flow. What are you working on today, and sort of how are you preparing yourself for the next opportunities?
Yeah, so outside of the stuff I discussed that we're working with this coach to sort of optimize our stuff, and we're spending a lot of time soul searching, figuring out who we want to be and how we're going to get there, and what we're going to do to make it happen. I'm still looking at deals constantly, right? Because sometimes you find a deal in an unexpected place. Finding spots for some of our 1031 money now for stuff that we sold out, and we've been successful there so far, even though, it's been a struggle, honestly, to find good stuff that makes sense.
Sure.
I'm also looking at a lot of small deals, to be honest, like anything 10 million and under, we could capitalize in cash. And, to me, that's a really interesting opportunity, because if you find someone who truly needs to sell now, you buy it in cash. You don't have to worry about messing around with a lender. You do the work, and 2 years from now, rates stabilize, and you go and you recapitalize the deal with a lender. And in this deranged, upside down world we're in, it makes more sense to buy a lot of these deals in cash than it does to put every dollar of leverage you put on the cash deal is becomes diluted. So leverage has gone from being your friend to being your sort of adversary. And so we're looking at deals 10 million and under, and I'm also looking at interesting opportunities. Like, I've been peeking at a couple of industrial opportunities. We built an industrial building up here in Jersey, my partners and I. And so we get the space, and we own a couple other small industrial deals. So we're looking at stuff like that, and honestly trying to find anywhere that makes sense to put some money out. I've started to look more keenly at affordable deals or mixed affordable deals, which I think could be really interesting given the climate we're going to go into, where, you're seeing some of this product that's, for me, it's all about basis, right? I'm a big per square foot guy, big basis guy, and big rent per square foot guy. So you look at it and maybe you buy a deal 7 years or 8 years left on the contract, but you're buying a 2000 or 2005 vintage deal that's, like I said, right, it's 30 years. So you're roughly in that time frame we're talking about, where you're buying this thing for 60, 70, 80K, 30, 40% below what prevailing market would be for those assets. So you buy it, a lot of the headroom has increased dramatically because CPI has been wild, right? And a lot of these owners that have owned for a long time, they haven't kept up. So you see some of these affordable deals with 15, 20% headroom. Do you get all of that? Maybe not, but it's kind of an interesting baked in upside opportunity to buy good sticks and bricks at a good price per square. And then if you hold it long enough, or you come close to that, you resell it to someone who's going to be that next owner looking to then monetize that roll to market and that sunset. So we've been looking at some of that stuff. That stuff to me is interesting just on a basis play. Yeah, man, I'm just trying to not get over our skis and make good bets that make sense and feel good. And I throw deals in the trash when I see them come across, and it's $200 a square for 70s product.
Yeah.
That's a mess, So
yeah, you're seeing a lot more. You're seeing a lot more adjusted pricing guidance emails from brokers these days than.
Oh yeah.
So actually, that brings up another thing I wanted to ask you. I know you've done a few deals with us up in Charlotte, and what did you like about, what have you enjoyed about working with Capstone? Not to make it a commercial or anything, and then sort of like, what are the aspects of working with a broker that you place high value on, and where do you? I like it. See, there you go. Nice.
Yeah. I took it out just for this. I took it out just for the podcast.
Yeah, love it. You got to fill it up with something other than water, though. I guess
I got some whiskey in there. If you come up to Jersey, we'll have some.
All right. No, but I mean, why did you decide to hire Capstone for those assignments? And what, if you've got an assignment tomorrow, and what are really you looking for in the broker? Not necessarily the company itself, but just like the individual and the types of traits and characteristics.
Yeah, so that's a great question. So Ron and Eric and those guys, I've known those guys since I got into the Charlotte market, Ron in particular. And for me, it's always been about relationships, right? I was a debt guy before this, and you see how quickly someone's willing to finance a deal for you, and then they're not there next go around, or pass you business on the other side and not next go, or sell you a deal and then give it to someone else to sell. And for me, it's always been about relationships. And I think over time, a lot of people have sort of beat down the sort of broker position, or thought they could cut it out or do this or do that. And at the end of the day, like, each of us only wins when we all win, right? So for me, it's always been about relationships. You sell me a deal, you're the first call when I want to sell it. If you shit the bed and you don't sell it for what we need to, different story. And that rarely happens, but it's always been about relationships. So I think being honest and doing what you say, saying what you do, just just doing that, you pass 50% of the people in the market, right? We say it even about us to investors. Hey, by doing the right thing, you're already ahead of half of the pack. Real estate's one of those industries that it attracts a lot of funky people for whatever reason. It's like, hey, funky people come do business. It's like one of those businesses that just attracts it. So if you're a decent person, you already get halfway up. So I think that relationship has played well. But more than anything else, I think I count you guys as advisors, quite honestly. And I know if I call, the Charlotte office, or if I call whoever, or conversely, if I'm looking at a deal in Knoxville and I say, hey man, this isn't a capstone deal, but can you connect me with one of your guys in Tennessee that I know is going to shoot me straight and not give me a line of BS? I know whatever info I'm getting is legitimate, clean, and it doesn't have a spin on it. And that's the important thing, right? Like, trust is very big in this business. Sure, contracts exist, right, for that purpose, to keep people engaged, to say and do what they're going to do. But having that advisor and that person you can bounce something off of, that's true and genuine, and is going to shoot you straight. And I've had Ron tell me stuff before. I'm like, hey, here's what I think. He's like, nah, dude, like, look, I love you. You're one of my best clients, but don't go down that path.
Yeah.
And having that is invaluable, right? And these are people who help guide you. And at the same time, he knows that any deal he sells me, come hell or high water, he's going to get paid on it, right? Or he's going to bring it to market for us and sell it. But there'll always be that expectation of business, begetting business, and what goes around comes around. So it's just a true, genuine relationship. And what you see is what you get. And I think that's important, because not a lot of people out there like that. Plenty of people I've dealt with over the years that it's the opposite. They tell you one thing, and then all of a sudden flip of a switch, it's gone. So I think that's, I wish I had a better answer for you, but it's just true, genuine.
I think that's spot on. We like to, that's sort of how we've tried to operate is build those relationships, and sometimes it's playing the long game, but it's also doing business with people who you enjoy doing business with too, right?
That's right. That's right. So just long-standing relationships, and like I said, doing the right thing goes a long way, my friend.
Cool. Awesome. Well, to round it out, we always do some rapid fire questions. So I'm going to fire a handful of questions at you and let you just kind of, answer the first thing that comes to your head. So what's the best book that you've ever read that really, before we get into that. So Art of the Deal, we just hired a broker like an associate broker up in Jacksonville. And he asked me 2 books, let me know what books I should be reading. And one of the books I told him was, I said, look, I know it sounds a little bit cliche, but read The Art of the Deal by Donald Trump, because it is a really good real estate book about, deal making. And so I read that book. I read that book when I was getting into real estate, and it still sits in my office at home. And whatever you think about Trump, it's a really good book.
Yeah. Yeah.
So what's the best book you've ever read that really impacted you?
So putting me on the spot is hard. I'll tell you a book I read recently, though, that our business coach made us read. And it was one of those books that looks like corny, looks like something you probably like whatever self-help book, like Don't Jump, right? Like one of those. Right. But it was the 7 Habits of Highly Effective People.
Okay.
And it's funny because, again, it's one of those cliche books, but I've got to tell you, and I've read it before, but you don't really absorb. It's one of those things you just read over and over again through time. But a lot of it really makes a lot of sense. And again, none of it's freaking rocket science. It's just someone who's corralled all these ideas that make a lot of sense and put them in one place. And you probably won't, retain everything from it, but you just get little nuggets, here and there. And honestly, it's really good. If you've never read it, I would say you should read it, and you'll pick up some stuff from it. You will. It's worth it. So,
I have never read it, and I always see it, and I always tell myself I need to pick that book up and try and read it at some point.
You should. You'll enjoy it. And I'm also reading Stephen Schwartzman's book right now. Right? Real estate guy reading the Blackstone book, but someone gave it to me. Someone gave it to me as a gift, and I got to tell you, it's really good. One of the few books I've read in a while that I sort of had trouble putting down. I was reading it on a flight to Charlotte, and it was one of those things like prepare for landing, and you hit the runway and you're still reading it. Pretty solid book, man. and he's an interesting guy, and it's a good book. It's a good book. It'll capture your attention.
Cool. What's a podcast that you recommend to people in either entrepreneurship or real estate?
So I will fully admit I am not a big podcast guy, and most of it's because I spend my time on the phone going blue in the face, and I talk a lot, as you may or may not have ascertained from this this probably extra long podcast. But I don't know. Haven't never been a big podcast guy because years ago I used to travel in the car a lot more, and we owned stuff up here. We'd always be hitting our assets. Now that I fly down to Charlotte a lot, or Wilmington, or Charleston, or wherever, these flights are so short, right? They're like hour and 10-minute flights. I'm usually pounding away on emails. I'm doing this, and occasionally I'll read a book if I'm not sleeping. So fully admit, not a big podcast guy. Don't have a good answer on that, but I would say that
we won't hold it against you. It's all right. You don't have to make.
All right. Yeah, I was trying to that was my long-winded way of trying to investing in multifamily. I did some generic.
Yeah. I mean, you're not listening to 3-hour Joe Rogan podcasts?
No, I'm not. Although my best friend, he's like a brother to me. He absolutely loves Joe Rogan. He's been trying to get me to listen for years, and I feel like I'm so far behind the 8 ball at this point. I give it up.
All right. What is one piece of advice that someone has given you that's helped you get to where you're at today?
All right. So that's a good one. So I think if you do what you love, the money will always come. And a guy who gave me that advice, so when I got the job at Berkadia as a banker, this guy I knew, and he was heading the office at the time, great guy, and lives actually by me here in Jersey, but good dude. And I'd always known him before. And he's like, Frank, you're a type A guy, you're a salesman through and through, you show well, blah, blah. Like he was like, you are the fit for this job. And when he offered me that job, that same day I'm getting offered a job at a real estate PE shop, white shoe sort of place where they were buying fractional interest in skyscrapers, and they'd buy them from these families. They'd basically get to a point where they had enough control, and then they'd force a sale. But they'd buy, discounted positions from these people because of the illiquidity, right? And the job was super interesting, and the pay was outrageous out of the gate. And, you're working with the type of people that are just, the guy that ran the shop was just worth a few $100 million, right? He just bought like this massive compound in the Hamptons. And you're like, wow, this is like, I'm going to make some money if I work here. And then there was Berkadia, where they're like, look, you're going to eat what you kill and whatever. And the sky's absolutely the limit. Like, you want to make, bajillion dollars a year, you put your mind to it, you can do it. You want to make a couple $100,000 a year and take vacations and do whatever. Like, that's cool too, right? Classic brokerage sort of, or bank, banker type model. And he had convinced me, because he's like, look, man, like, why are you even worried about money? It's like, you're going to do freaking fine for yourself. Like, trust me, I know the type of person you are. You're going to come back to me 10 years. Like, you're going to do okay. Like, so don't worry about it. Like, you might make a little less upfront here, but I guarantee you will make more long-term. And he was 100% right. And, it was one of the, I think, necessary building blocks for me to do my own thing, to understand the finance side of the business and understand it well. And in the beginning, I used to broker our debt for us, to save us money and not getting taken advantage of. So that's one thing. And then I'll tell you something I always tell our analysts here, and then like other young people. And I always say, like, I'm a big talker, actually, extrovert, 1 to 10, I'm like, 18 or whatever.
Right.
You never know who you're going to meet. I talk to everyone and anyone. If I'm at an airport, you're having a beer, I talk to anyone, and I have made some very interesting connections and found out interesting stuff, and it's always paid off for me. So you never know who you're going to meet. Always talk to people, always break out of your shell, and some, you got to do things that make you uncomfortable. And then eventually you become very comfortable in that, like, uncomfortable realm,
That's great advice. I used to always dress a certain, now I don't give a shit, but I used to always dress a certain way when I was traveling, in case I met somebody who was, I was in a position to do business with. Yeah. Is there anything you would change about your approach to your career today, knowing what you know now?
in that approach to my career, I probably would have gone out and gotten as much money as possible to buy even more product in the Southeast, to be honest, because, had we even done 2X or 3X what we done, it would have been absolutely outrageous. But, hindsight's 2020, right? You know what you know. Yeah. But, and I think I would have spent less time in the Northeast investing. We did well. We did awesome here. Don't regret it at all. But had I taken all of that energy and put it in the Southeast from the beginning, we would have been in a much better place now. But from a career perspective, no. I mean, I think everything happens for a reason. I think you sort of find your way through. And if you like what you do, you never work a day in your life. Like, I don't get up every day and say, blah, 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 grumble, right, and come in, drink 10 coffees. I'm always on, right? Like, this is it's like, it's ingrained in me and I love it. And I got to tell you, super happy I didn't go the finance route. I have a couple of buddies still in finance. They do great. They make great money. But those jobs that were like so lucrative, like pre 08, 09, where like, you have half a brain, you make $1 million a year as like a trader or something, like that stuff's gone the way of the birds, man. Like, those jobs have thinned out. So super happy I didn't do that. And glad I had art of the deal and a financial crisis. Pushed me in the right direction.
Last but not least, what's the one thing you've yet to accomplish that you'd like to pursue in the future?
Ooh, I don't, it's funny. There was a period of time, this is like going back like 5, 6, 7 years ago. I was like, I want to climb a mountain, right? Like, legitimately was like in my head, like, not like, doesn't have to be like, Kilimanjaro or anything like bizarre, but I was like, I want to climb a mountain. And then that sort of was like a fleeting thing. Like, it came and went. And just because I really don't like the cold, I realized I really hate the fucking cold. Why am I subjecting myself to this? But I don't know. I think I'd have to come back to that. Hopefully the next time we chat and I come back to that. I'll tell you though, there's one thing I'm always working on doing, which is improving my golf handicap. And it's been a slow downward trend, but I'm chipping away at it. So my goal for this year is to get under a 20. I'm like an 18 now, so pretty satisfied about that, but that's not like a life goal.
Take advantage of the slow market and work on your game now, because once it ramps back up, you'll have less time to play golf.
Well, and that's what it always was, right? Like, I'd always tell our investors, like, would you rather my handicap be low or your returns be, someone's got to get.
That's right. That's right. Well, cool, man. That's it. I appreciate you being here today. Really, really enjoyed the chance to get to know you and chat with you a little bit and talk about everything you got going on in the market. And look forward to doing it again sometime soon over a beer.
Yeah, no, absolutely. It's been great. And the sort of conversational thing is nice. It's not structured. It's not super formal. I enjoyed it. I think it also gives you a chance to get to know someone for real, right? And not have it be this facade of, we invest in value add in the Southeast, and it's like this whole contrived, but yeah, it's been an absolute pleasure, man. Thank you so much for setting up. Q, I know you're off camera, but thank you for setting it up as well. And there he is.
Are you going to be in Vegas?
Yeah, you know what? I think I am. I'll probably be there for a couple of days. So we should get together and
at least just get a chance to say hello. Yeah, for sure.
Yeah, we're doing a lot of business development now. So maybe at some point I make my way down to Tampa or something and we get out and sort of you give me a little windshield tour, some stuff you got going on. And
that'd be great.
We'd love to. So
that'd be great. Awesome.
All right, cool, man.
Thanks, Frank.
Thank you so much.
Thank you for listening to Multifamily Method. If you enjoyed today's episode, please give us a rating and a review on Apple Podcasts. It helps our podcast get discovered by other savvy investors like yourself. Subscribe to Multifamily Method for free on your podcast platform of choice. Find out more about Capstone Companies at capstone-companies.com. Multifamily Method is executive produced by Capstone Companies. Audio production for the podcast provided by Andy Go of Gojo Studios, and video production by Yash Mystery of Mystery Projects.